Will COVID-19 crash our property markets? Well, the fallout from COVID-19 is becoming not just health, but economic, social, and yes, it is going to affect our property markets. And that's what we're going to spend time chatting about today. I'm going to give you some of my thoughts, then I'm going to play you the audio of the regular weekly Property Insider video chat I have with Dr. Andrew Wilson, where we discuss what's going to happen to the property markets. Are they going to be killed off? Is Australia going to fall into recession? What does it mean? What can you do? And then I'm going to have a chat with Andrew Mirams, Director of Intuitive Finance, who's going to tell us what the banks are doing, what you can do if you're in the position to get more finance, how you can take advantage of the opportunities at the moment. But if you're in trouble, if you haven't got the rents coming in or you've lost your job, what you can do and how the banks can help you as well. So lots to understand, so that at the end of today's show, you're going to have a bit more clarity, a bit more direction, a little bit more certainty, because things are changing constantly. So between now, when I'm recording this, and when you're listening to this, things will change again, but I'll be back regularly to discuss these with you. But for the moment, let's get on with today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted Australia's leading property investment advisor. That's the fifth time he's won a similar award in the last 7 years.
How will the fallout from COVID-19 affect our property markets? Well, it looks like they're going to be shut down soon. Currently, Australians are living through one of the most significant economic and social upheavals in our history. Our economy is being massively disrupted, and Australians are having to quickly adjust to new ways of living and new ways of working as our government urges us to keep our distance, stay at home and stop the spread. And there's lots of uncertainty about the future of our health, our economy and our property markets. And no one really knows the full economic toll, with jobs and business losses mounting by the day. And we're not really sure what's going to happen to our property markets, but I'm going to try and help you understand that. However, most economists are accepting the fact that we're heading, if not already, into a recession. But they're wondering, what's the final impact going to be of COVID-19? Is it going to cause our property markets to crash? Now, the doomsayers are out there again, and they're stalking me on Twitter and Facebook, and particularly on YouTube, and I have fun bantering with them. But I don't think we're going to have a property crash, and I'll explain why in a moment. But I know that the government and the economists recognise that the property industry is essential to sustaining the economy through these incredibly challenging times. And it's going to be a very big driver behind the recovery when it happens. So the government's going to support us as well. So while I'm concerned about my personal health, not that I'm sick, but I don't want to get sick, and I'm concerned about the health of the economy, even though I know it's going to get better, I'm not really worried about the long-term health of our property markets, because the Reserve Bank and the government are building bridges to get us through from where we are to where we're going. Now, I know there's not going to be auctions for a while. I know there's not going to be any public open for inspections for a while, but there's probably going to be private open for inspections in the next little while. But it's possible that if lockdown happens more, that the property market is actually going to stall for a while. Now, interestingly, the property market stalls for 3-4 weeks every Christmas. You know, solicitors go on holidays, banks go on holidays, agents go away, conveyancers aren't there. So the property market stalls and then it restarts again. And that could be what's going to happen, but it'll start with much less confidence. But if you're looking back in history, it's clear that residential property has always performed relatively well at times of negative economic shocks. Just go back to the global financial crisis, and the property market boomed after that. Go back to the China steel glut a while ago in 2015, and the property market picked up, but the stock market crashed. Go to the dot-com bubble, where the stock market plummeted in 2005, I think it was, and still the property market boomed. The Asian financial crisis, Australia's recession that we had to have, one after the other. The long term's secure, and I've discussed that in previous podcasts. But in coming weeks, property transaction numbers are going to fall significantly. But I'm not really sure what that's going to mean for property values, because how do you understand that when what's auction clearance rate mean if you don't have auctions? What does property median prices mean if nothing much happens for a month or so? So don't get too caught up on the numbers. What is going to happen, unfortunately, is consumer confidence is going to slump because of the share market fall, because of economic uncertainty, because of job uncertainty. And it's clear that job security and consumer confidence are critical when making big purchasing decisions, such as buying a new home or an investment property. However, in the last couple of weeks, I've been speaking to many of our clients at Metropole. Well, I tend to deal with a very small group of high net worth clients, and these are all experienced investors who've lived through a couple of property cycles, who've got secure jobs, and they see this as a short-term blip in their long-term investment journey. They recognise at times like this, at a time when many people are going to sit on the sidelines waiting to see what's going to happen, they see this as a great opportunity to buy properties considerably cheaper than what they would have paid, I don't know, a couple of months ago, and very likely much, much cheaper than they're going to pay in 6 to 12 months' time. Because we are going to get through this. We are going to get over this. And so I'm finding two groups of investors, those who are sort of sitting on the sidelines waiting for it all to happen and sort of hunkering down and putting their head in the sand, and others who are actually taking action to get ready to get set for the next stage of the property cycle. Well, there's three groups, actually. There's one group who's just treading water, and at the end of all this, they're going to end up where they are. There's a group who actually are sort of turning a blind eye or getting scared or wanting to sell up. But the successful investors, the strategic investors, are saying, hey, now's the right time to get finance because the banks are still open. It's the right time to set up the right structures. It's the right time to get a strategic property plan in place so that when the markets open up again, when industry starts working again, they're going to be ready and set for the next stage of the property cycle. Now, I don't know your personal circumstances, but what I do know is if you'd like to understand what all this means to you, whether you should get set up or whether you should just hold tight, I know that our team at Metropole can help you. My team is spending a lot of time doing strategic property plans for clients, getting them set for when things turn. So I'm not saying it's right to buy a property yet, even though if you're ready, I know a lot of successful investors are taking advantage of the opportunities. But why not have a chat with my team at Metropole? Go to metropole.com.au or give us a call at 1300 Metropole and we'll catch up with you virtually because, hey, we're not seeing clients face-to-face at the moment, but we've got technology to see people from all over Australia. And why not assess how your portfolio is going to stand up in the next little while? Why not understand what options are available for you? Because we'd like to give you some clarity. We'd like to give you some certainty. We'd like to give you a level of direction of what to do next. 1300 Metropole, or go to metropole.com.au and organise a time to see whether a strategic chat would be of benefit for you. And now we're going to have a chat with two Andrews, Dr. Andrew Wilson, about the general property market, the economy and recession, and then Andrew Mirams about how the banks are going to help you and what you can do if you're in a little bit of financial trouble. It's been a week since our last Property Insider chat with Dr. Andrew Wilson. And while we were planning to give you an update today on the COVID-19 situation in our property markets, it's really hard to know where to start. So much has changed over the last week. And by the time you get to watch this video, it's likely a whole lot more changes will have occurred. But let's have a chat with Dr. Andrew Wilson, Australia's leading housing economist, chief economist of myhousingmarket.com.au. Welcome, Andrew.
Yes, thank you, Michael. Certainly it's been an unprecedented week. I think these unprecedented times will continue for some time yet, but let's hope it does end sooner rather than later.
Well, that's what everyone wants, because as you say, we are living in extraordinary times. And let's be blunt, they are challenging times. The coronavirus is first and foremost a major public health issue, but clearly it's actually developed into a major economic problem and having deep ramifications for financial systems right around the world. Now, they're not my words, they're actually the words of Philip Lowe, Governor of the Reserve Bank, And I was comforted to hear his continuing words where he reminded us that as our country manages this difficult situation, it's important not to lose sight of the fact that we are going to come through this. So the Governor of the Reserve Bank was talking about, and Scott Morrison, about building bridges to help us get to the other side. So their focus is on supporting businesses and households who are going to suffer. We're all going to take a hit to our incomes at the moment. And while I'd like to discuss what they're doing in a moment, Andrew, I think it's important to discuss the big factor that's concerning people with property at the moment, that our housing markets are going to shut down to a degree, if not completely, for a few weeks or more. Recently, the Prime Minister announced new restrictions on social gatherings, and that stopped open homes or public open homes. It stopped auctions. And while it could mean that there's still going to be private sales occurring through private inspections, it's not too long before further restrictions are going to occur, even maybe before people watch this video, Andrew, where they may not even be able to go to those. So what does this mean for our property market?
Well, yes, Michael, it's unprecedented in terms of being almost a stop to buying and selling activity. Typically, we see the ebb and the flow of the cycle, and we obviously get trends. We saw a quickly moving market upwards at the end of last year, the beginning of this year, and the reverse, of course, through the end of 2018 when markets were falling sharply. And, of course, the reason there was sharply declining buyer activity. There was the fear factor that had moved into our housing markets. Buyers decided all those, as now been proved, ridiculous predictions of catastrophic price falls. Buyers, not surprisingly, sat on their hands through the end of 2018 and into 2019. But the market did recover, as we know. Confidence returned. It was a cyclical factor. It was really something where eventually the underlying fundamentals kicked in and the market regained ground quite quickly in Melbourne and Sydney and was just about to get back to its previous peaks when along comes the coronavirus. And of course, that means all bets are off. And that's why this is an unprecedented event, because it's, to a large degree, Michael, it's just basically saying, look, we're going to stop any buying and selling that's going on. Now, obviously, you can't do that as a pronouncement, but the point is that not just the fear factor now, and people will be concerned about the future. That will mean that those buyers and sellers that are discretionary will sit on their hands and wait, as we saw in 2018 and early 2019. We probably will even have fewer of those non-discretionary sellers in the marketplace, those that sadly are confronted with death or divorce or moving interstate. I think even those factors will be put to one side in terms of those activities being halted, which will mean even fewer of those non-discretionary sellers in the marketplace. So it does mean that we're going to get very few sales going through the system, almost an unprecedented collapse in sales, I believe, in the offing. It's not just a question of the fear factor, it's also the issues of not being able to conduct business as we're used to conducting business in a face-to-face environment, whether it's the auction, the open house inspection, the negotiation, whatever it may be in terms of property buying and selling. That's certainly going to be severely constrained. Unfortunately, when these events occur, because the few sellers that are left in the marketplace typically have to sell, we do see price models obviously tracking sharply downwards, which tends to reinforce the negativity and the fear factor from sellers, and that does take some time to recover. But look, I guess we've just got to hang on to our hats, Michael, wait for this to pass. It is a health issue. It's nothing to do with the economy per se or the housing market per se. That was kicking along quite nicely to start the year this year, and the prospects for a strong year were certainly quite solid. But of course now, as I said, all bets are off, and we just have to wait for this health issue to be resolved sooner rather than later, and then we can take off, not quite where we left off, but certainly I think we'll build a little bit quicker into a recovery in the housing market than we've done when markets have declined because of underlying cyclical factors.
Because the underlying factors are still positive. Strong population growth, the lowest interest rate ever, the cheapest it is to hold on to a house. People are still getting married, still getting divorced, still having babies, needing to move house. The problem is, Andrew, some people are going to get caught in this vortex.
Yes.
There are some people who sold a while ago and have now put their properties up for auction. We were coming up to the peak auction season.
Yeah.
They're going to be in limbo.
Yes, look, this is obviously a conundrum for those, and I think we do have to look to governments to be able to ease that financial stress on those sellers that have committed themselves to a contract, that obviously have to meet that contract, that purchased a property, and in the prospect of selling their property to fund that purchase, and now obviously with the prospects of a sale being certainly more remote than they were when the market was up and running a month or so ago. So, I mean, what do you do? People have to be able to given some breathing space. This is the role for government now. Government have mandated these policies as a risk management factor for the coronavirus. They now have to be able to support all those as innocent victims, financial victims.
Well, the government's working its way through support. So they're talking about support to tenants, support to landlords, residential and commercial, and that will probably occur over the next little while anyway. They're giving support now. Andrew, I'm concerned that is there going to be enough in the coffers to give support at the right time, because we've got to get through this. But once we get through this, and we will, and it'll probably be 3, 4, 5 weeks, we actually have to get industry going again. Yep. Will they be able to do that?
Well, that's important, Michael, that we differentiate between what is now the risk management period and then the recovery period. Now, the recovery period, as I said before, hopefully will be sooner rather than later. I think a month's about it from my mind. I think after a month of these draconian restrictions, really we're going to start to be creating more problems than we're trying to solve. And I mean in terms of health problems as well. So we need to be quite circumspect about that. Governments need to be mindful of the damage this is going to cause and to be able to balance the mitigation policies against what their effects will be, not just on the economy, but potentially on health as well. I think that we need to be ready to go with an unprecedented stimulus package once we're moving through the quarantine process. I mean, obviously people have to be supported in the short term in terms of being able to sustain themselves. But I think that in terms of getting the economy up and running again, we need to go in with all guns blazing as soon as people can go back to work and as soon as businesses can start to regenerate themselves. This is where governments have, obviously a key role, but they have a moral role as well to be able to do whatever it takes, spend whatever they have to get our economy up and running again. And as we have discussed previously, Michael, our economy, compared to most of other advanced economies, at least is in reasonable shape to be able to do that.
Well, in his speech recently, Reserve Bank Governor Lowe said that Australia has a strong financial system. It's well placed to provide the needed support to businesses and to households. He said the system's got a strong capital and liquidity position. And APRA has also confirmed that there is large buffers of capital and liquidity in the system. That's a bit different to last time during the global financial crisis. Liquidity dried up. Money was hard to get. We're in a better position this time around.
Well, the point is that there's, even though it's a little peculiar, there's more certainty now because this is a health issue where we're not allowed to mix, where we have to remain confined. As long as we can sustain ourselves in terms of paying our bills and obviously food and clothing, these types of essentials, then we will wait this thing through. In the global financial crisis, we were, facing a global economic shock. We didn't know where it would lead to, and we get issues to do with the financial sector, such as the potential for a run on the bank. Now, these things start to foment when you do have these sharp declines in economic activity, and the government stepped in during the GFC because there was a sense that the banks didn't have the capacity to guarantee all their funding, and of course now the Commonwealth now guarantees all deposits in banks. So we don't have to worry about that as a potential, negative for people being concerned about having liquid assets. And of course, these days we don't have cash as a commodity as we used to. Now most of our transactions are done in a digital environment. So really that's a good thing in a way that we don't have to worry about that prospect of having to have enough cash on hand to be able to survive, and therefore we go to the bank to withdraw all our cash. That's a good thing about this environment, is we learnt that lesson from the GFC period. At least we can be positive because the evidence, as it's revealed, has shown that there is a finite period to this illness, that it has moved through other countries where it was an early stage issue, such as China, South Korea. So we know that hopefully we'll have an end to it sooner rather than later. But as I said, the main game then will become recovery. And for the property market, perhaps, if anything can be a positive, maybe in the best of circumstances, we're basically having a longer winter selling season, Michael, and we can start thinking about a revival in spring. I think, which we haven't sort of mentioned, governments would be mindful of previous experience in terms of regenerating our economy, to look to the property market as a toolkit for that, as we've seen previous governments do during times of financial stress.
Well, I remember way back, Bob Hawke got
Yes.
first homeowner grants, getting the construction industry going, and what that made people do was buy televisions and refrigerators and
Yeah, that's right.
It's a great way of getting industry going, isn't it?
Well, it is, Michael, and I think we've already seen the energy that a handout to first home buyers can create in the housing market. We see that, as you said, Bob Hawke brought that in 83 following a severe and a sharp recession. We then saw Rudd introduce that during the GFC 2009, with the first home buyer deposit boost, which was a great fillip for the economy. And as you said, there's plenty of tentacles that come out as a result of energising the housing market, construction, white goods, all these bits and pieces that are associated in it. And it really is a strong driver of economic energy when it's activated. And we still have plenty of aspiration for home ownership. Plenty of first home buyers would want to get into the housing market. And I think that governments should think about a real significant boost to first home buyer buying capacity when we move into this recovery phase. I think there are other mechanisms we can think about also, Michael. I think we can think about regenerating, as I said, housing market activity by perhaps introducing something we haven't had, and that's tax deductions for mortgages. We can think about a mechanism whereby new mortgages for a period of time are allowed to be tax deducted. We can also think about mechanisms for activating those risk takers in property, such as developers, such as investors, to give them some accelerated access to cheap finance for them to become active, as I said, in residential investment or property development. So I think there are avenues for the government to use through property to be able to regenerate our economy sooner rather than later, as has been proved in the past.
People are losing their jobs, and there's a number of economists coming out with suggestions of 7%, 10%, double-digit unemployment rates. Recession seems certain, but the pessimists are out again. They're using the D word this time. I told you so, they're telling us we're going to have a depression, Andrew.
Well, they don't know what they're talking about, Michael. This is all guesswork. It's headline chasing, and it is all guesswork. They don't have a clue what they're talking about. They're just picking a number and hoping they'll be right. We shouldn't be playing this game, how high unemployment's going to go. We should be working on mechanisms to reduce any unemployment that we do get coming through, rather than looking at some sort of a numbers game, some sort of a prediction, crystal ball gazing environment. And that's it. They have no idea what they're talking about. And it's just guesswork at the end of the day, because nobody knows. We don't even know how long this particular episode is going to run. A lot will depend on the government action to offset the negatives. And as we said at the beginning, this country is fortunate, very strong exporter still. Iron ore and coal is still finding customers. We have a small population. We were roughly in budget surplus in the last budget, whereas most other countries are in a budget deficit position. If you look at the US has a $1 trillion, had a $1 trillion deficit before the coronavirus issue, which was 4% of GDP. So we're not even close to that, or we're certainly not close to that prior to the coronavirus. And of course, the US is pump priming and prepared to stimulate its economy too. So we don't have to worry about the ideological claptrap of not going into deficit, which has been holding us back to some degree, and also any worries about overheating parts of the economy through a stimulus package. Let's take a cold shower, guys, and forget playing the name game and chasing headlines with these sort of scare tactics.
Well, the government's given incentives to people on low incomes, people who've lost their job, but they've also given a $90 billion economic stimulus package to the banks, and they're encouraging them to lend and lend at particularly low interest rates. And that's good. And the banks are open for business, and the banks are also there if you're running into trouble to either pause or reduce your payments as well. So this is unprecedented in my experience, that the banks are stepping in very early to underpin our economies, our own personal budgets and the property market.
Well, banks have a moral obligation, Michael, to do this. Let's remember that we have a very strong banking sector for banks. This strong banking sector with obviously low levels of competition, high levels of market power, has been allowed by our government so we can have a highly risk-managed financial sector. That's a good thing. It means that we don't take risks with our borrowing because banks can afford to be not inclined to follow the market dynamic, and that's because they can make profits through the cycles and business cycles. But this is the time where banks have to stand up. They have to offset the corporate agenda of profit chasing and start to realise that they're in a position, because of the political strength or the political outcomes of the government allowing this type of, or this banking sector with strong market power, and therefore we need that market power now to be delivered and likely offset against bank profits to be able to see us recover sooner rather than later.
We will get through this, not just because of the government, because of the resilience of Australians. And it's actually good to see people helping each other, people being compassionate, looking after each other. So I look forward to having a chat again next week. Boy, we're going to have a lot of things to discuss, but what we're probably not going to discuss next week are the auction clearance rates.
Yes, Michael, this is quite extraordinary. This has come at the wrong time for the market, in a sense that we were expecting an absolute truckload of auctions prior to the Easter break. We had with our quieter market a year ago, sellers were quite reticent to get into the marketplace. So we've had a flood of selling activity this year, reflecting what's strong competition amongst buyer for property. Now, we were looking at thousands of properties going under the hammer in the 2 weekends before the Easter break. In fact, the highest number of properties being offered for years. The people have made decisions to go to auction prior to the coronavirus issue. They've committed themselves to marketing campaigns. They've paid money, lives on hold. Now, we're going to see virtually that stop, not just, as we were discussing before, as a reflection of people's concerns, but also because we've now seen open for inspections and public auctions being banned. And I guess if we want to speculate, I'm not sure what the relevance of an auction clearance rate will be going forward, because it's not a market reflection. It's just a reflection of the constraints for buyers and sellers.
Just as auction clearance rates won't be that relevant, I think median prices or sale price statistics,
absolutely,
a very small market is not going to be relevant either. But people are going to come out with headlines saying, look, property prices have dropped 10, 15, 20% because there's been 2 sales. That doesn't make sense.
No, it doesn't, Michael. And again, it's useless to speculate on how far prices, I've been asked, how far prices are going to fall. It really doesn't have much relevance because it's not reflecting market value. There'll only be a handful of properties transacted. It's not really reflecting underlying value in our properties. That will come back when the economy is back where it should be.
We need to get some volume back into the market again. Look forward to our chat next week, and I bet you there's going to be quite a few things changing between now and then.
We'll still be here, and let's hope there's some better news, Michael.
Looking forward to it. Well, there is good news. We've only spoken about negatives, so let's finish off with the fact that there are people who've almost found vaccines. They're trialling vaccines.
Yes, absolutely.
A number of new cases in China have decreased. You've got to look for the good news too, don't you?
Well, as I said, Michael, on the exposed evidence, this thing has a finite life. And with a bit of luck, it'll be sooner rather than later. There has to be, obviously, economic ramifications. Governments are there to make sure that has as minimal impact on Australians as possible once this health issue is behind us.
Well, I'm sure we're all looking forward to it. Thanks for your time, Andrew.
Thanks, Michael. Good on you.
If history's taught us anything, it's the only constant in life is change. over the course of the last century alone, there's been a litany of challenges, numerous disasters. All of them have one thing in common. They've all passed. Some months from now, and it's going to be impossible to predict the timeline. It could be 6 months, could be 12 months, could be a year or more. The current situation we face with the COVID-19, that's also going to have passed. Just as with the bushfires, we're going to be left with a wake of debris, destruction, and we don't want to take it lightly, but it will pass. And as property investors, another area of constant change seems to be the world of finance, the world of banking, the world of lending. So to better understand how the coronavirus pandemic is going to affect your borrowing capacity and what you should do if you find yourself in financial stress, either because you've lost your job or maybe some of your property income reduces because your tenants can't pay you, I'm looking forward to this chat with leading finance strategist Andrew Mirams, Director of Intuitive Finance. Welcome, Andrew.
Hi, Michael. How are you in these very interesting times?
Well, we are socially distanced, aren't we? You're in your office. I'm in my home office at the moment, which is good. So I'd like to ask you some common questions because a lot of people are very nervous and it's understandable. I hate using the word everyone else has used, but they are unprecedented times. But recently, both our Prime Minister and the Reserve Bank Governor, Philip Lowe, have both used the same word, bridge. They said we need to build a bridge between where we are now and where we want to be in the future, because at some point in the future, the virus will be contained. Our financial markets, our property markets will return to normal. But it actually seems to me, Andrew, that our banking system is a critical part of this bridge. So let me ask you, are our banks open for business?
Yes, they are. I think the thing to understand, Michael, is even though this pandemic has brought things to the head, the banks are always very willing to deal with people in trying circumstances. That hasn't changed. And so what we've seen is they've come to the forefront with the measures that are available to consumers in everyday life, but also in this unprecedented times, repayment holidays and helping businesses try to survive through their cash flows, and investors and anyone with a home or an investment loan or any loan at all, they are there to help.
Well, it looks like the banks have been given a lifeline. There's been a $90 billion lifeline provided to them to get out there, to lend money, to stimulate the economy. And it seems to be at a really, really cheap interest rate. Now, I know many investors who've been trying to borrow lately have found the tighter credit policies, the responsible lending situation we're in at the moment, they found it harder to borrow. But Andrew, from what I'm reading, it seems that our banker regulators, APRA and ASIC, they've taken a more common sense approach in these uncertain times. They're actually allowing the banks to lend a bit more freely at the moment.
Yes, they are. I think it would be naive to think that we're going to get back to where we were, but they are open for business. We've had settlements every day this week. The banks are open for business. We've still got loan applications going in and they're being approved as normal. Now, I think what we might see in the near term, and this is moving very rapidly as well, the updates and the things that are changing, but we might see that if people are in any of the affected industries, they might have their income not allowed because of the uncertainty. If your income and your job is secure, the banks are open for business. And to be perfectly honest, Michael, we need the banks to be open for business. If the banking system shuts down, then the ramifications and I guess the knock-on and the domino effect of that would be far more wide-reaching than what people, I think, give it credit for.
Well, I think we've come into this terrible crisis in a much better situation with our banking system than we did the global financial crisis in 2008, 2009. We have gone through this period of more responsible lending. We've gone through a period where the banks have capitalised a bit better, and now the Reserve Bank has given them a lifeline. So we're very fortunate that the government, I think, has learned from the past also. It's not wanting to tighten credit. I remember in the past, there just wasn't liquidity in the system, but they're not going to let that happen this time, Andrew.
No, I agree. And they need to keep things moving. And I saw a really interesting statistic the other day. After the crash in 29 and then the depression, when the stimulus packages were brought in, so the crash happened in 1929, it wasn't until 1933. Now, 4 years later, now that's way too late. So all of our banks and all of our governments around the world, not just Australia, being as proactive as they can. There's lots of positives, and I think we need to talk about that. We're still getting loan applications in every day. We're still getting approvals every day, and we're still getting settlements every day.
So, Andrew, let's have a talk about the options available if you run into financial difficulty. You already mentioned one. Some people, if they've set themselves up correctly, and I know you set up your clients and our clients that way, they have an offset account or a redraw facility. What should those clients do?
Well, the whole purpose of having a buffer is in for unprecedented times, is for when you need it the most. So if your tenants leave and things like that, then the buffer is there for that reason. And we've spoken about it might be for a week, a month, a year. Well, let's hope it's not the longer term. But that's the whole point of having a buffer, having redraw, having offset accounts, having a line of credit. It's there for these times.
Well, looking at our property markets, I feel secure in the long term. I know we're going to get through this, and I know our property markets are underpinned by the fact that 70% of people in them are owner-occupiers, and they're not going to give up their houses, and the banks aren't going to take away their homes. I know a lot of people who've got mortgages are actually ahead in their payments with their mortgages as well. Does this give them the opportunity to reduce their payments now with the banks?
So anyone that's been paying and taking advantage of as the lower rates have been coming down and they've been putting extra money in or things like that, you can do a few things. You can continue, if your job's secure, you continue to take advantage of the low interest rate environment and repay your debt quicker. You can reduce your repayments back to the bare minimum if that's what you want to manage your cash flow. And then if you are really well advanced, you can do one of two things. You can either stop your repayments or redraw those repayments and allow then that redraw to help you with your repayments and your cash flow management in the short term.
Now, what about those people who aren't in that position where they aren't ahead in their payments? How do they go about reducing their payments or pausing their payments for a while?
And this will be where a lot of people are in, where they've had interest-only loans or they've maxed out their portfolio. They might have a buffer, but they might have some things. They might have tenants that are coming to them saying, we've lost our job and we can't repay. All the banks are open and really willing to help Australians through in this time. So they can do what they call a repayment holiday or repayment pause. Now, it's not freezing your repayments. It's not that you won't ever pay them. They're deferring them. And I think that terminology is really important to understand. So you still will be charged interest. You just won't have to pay that interest today. And you'll get a repayment holiday for 3 to 6 months or as long as you need to get through. You need to meet the hardship test. That's the other thing. Like if you've got hundreds of thousands sitting idle in your offset account, you don't meet the hardship. Hardship is if you cannot meet your repayments. Hardship is if you've lost your job and you have no resources to draw on. So that's what hardship is. You still need to meet the hardship criteria with all the lenders, but then they will happily suspend your repayments, defer them, and it'll go on to a later date.
Now, does this apply to owner-occupiers as well as property investors, Andrew?
It's for every person that has a loan. So if you only have one loan, it's an investment loan and you can't afford to repay, it does impact you. Every single bank, Michael, as I want everyone to understand, has a slightly different policy. They have a slightly different system. They have a slightly different way of doing it. They are there. It's for all lending, other than at this stage we can work out on lines of credit, which have a cap limit or like a credit card and things like that. But home investment loans, even fixed rate loans.
Rate cuts have been announced. In the last month, there have been two. Are they banks passing it on to ordinary home owners or investors?
So the first cut that came through at early March, all the lenders have pretty much passed on the 0.25% of that. Some of them have taken their time to pass it on. With the emergency cut that was announced, not many of the lenders have passed those through. Most of them have passed them through in different formats, maybe to small business and trying to help small business survive, and they've done some rate cuts there. There's only a couple of lenders, and in fact, a couple of our non-bank lenders and that securitise money offshore in a different way, they've actually had to put rates up because of the cost of their money.
Now, we've spoken about people who are in a little bit of financial problem, but some of our clients and the property investors are not in that position. Is this a good time to go back to the banks and just refinance your current positions?
For the last probably a year or 2 years even, banks' inflows and banks' writings of mortgages have been significantly lower. And they now understand it's easier to keep the loans that they have rather than trying to get new business. So yeah, it's a great time. In fact, we're doing repricings on all of our clients all the time, because when you've got this stressful, moment in time, the last thing they want to be doing is heaps of paperwork and things like that if they don't have to. So the first thing we'll do a repricing at their current lenders, and we're getting some really good results. Then once we've got that and we've got the information advice on that and they're still not satisfied, then we can look at refinancing with or to an external lender.
Now, for those people who are going to ask for assistance from the bank, they're going to ask for a pause or a delay or a cutback in their payments. Is that going to affect their credit rating? Is that going to cause troubles next year when they're looking for a loan when the world moves on?
The really good news is deferring your repayments in these times will have no impact on your credit worthiness or your credit file. It's an emergency need in time, and that's how it's being viewed by all the lenders, all the credit providers.
That's really good news. And I think the other good news is that we live in a fantastic country in currently very challenging times, but this too shall pass. You and I have been around long enough to have lived through recessions, downturns, crises. It's actually a bit like a terrorist attack rather than a war. We're not damaging our infrastructure. So the suggestion is, with all these financial stimuli, it won't be as bad a downturn. As long as the government, once we come through the other end, keep stimulating things, that's when we're going to need stimulus as well to grease the wheels of industry and get us going. But I think it's a great time, and I know a lot of our clients are doing it, getting themselves set for the next stage. So no, maybe you can't go to an auction this weekend, maybe you can't go to an open for inspection, but those who have their finance ready and pre-approved, because you and I have been through this, after every stock market crash, after every downturn like this, the flight to quality of residential real estate creates a property boom, Andrew.
I wish you'd stop reminding people of our ages, Michael. I think the grey hair and the no hair is reminder enough. But yes, you're right. Like, it's every other cycle. And we've spoken many times about cycles. This is a cycle. It's a jolt to the system, and it's been a significant jolt. But the GFC was as well, and we go back to all those times before, and again with 9/11 and certain things that happen in the world that we just can't physically forecast. What we do see is the world just normalises. Humans, I was going to say Australians, but humans in general are incredibly resilient. We will find a way to get through this. And I agree, for those that are well positioned and well set up, there's going to be some really good opportunities for the long term, Michael.
Sure. And the opportunities aren't going to take advantage of people, but the opportunities are going to arise there because there will be some discretionary people, buyers and sellers, who step out of the market. But there are always people who do have to sell houses because they've got married, they've got divorced, they've got kids, they've got to move, and there's other people who need to buy. So while the real estate market will close, or almost close for a short period of time, it's got to keep moving again. And the government recognises that.
The facts are that everyone has to live somewhere. So whether you're a tenant or owner-occupier, people have to live somewhere. And the fundamentals of Australia haven't really changed. We're just going through a health crisis that has got the potential to cause an economic crisis. And I think all the leaders of our country are fundamentally doing a really good job at the moment in trying to protect Australians as much as they can. Life will normalise. It will get back to normal, and the opportunities will be there. And the long-term investors, because you're not investing for the next 6 months or 3 months, you're investing for the next 10 or 20 or 30 years. And the opportunities will be there, and we'll look back like every other graph and every other event over the journey of time and say, gee, well, 2020 was a real challenge. But now look where we are.
So the banks are open for business. If you're in trouble, ask. Don't try and sort it out on your own. And if you're in the good position, take advantage of the opportunity to set yourself up with the right finance structures, the right ownership structures, so that when the timing is right with the right advice, you'll be able to own the sort of property at a price that cheaper than you would have had to pay a few months ago, and probably cheaper than you're going to have to pay at the end of the year when the surge hits us. Thanks for your time, Andrew.
Pleasure, Michael.
Well, that show is a bit longer than normal, but the current circumstances warrant extra time spent understanding what's going on. And if you got some benefit from this, please pass this on to some other people, because we're trying to get as many people as possible to understand their financial options and not get too scared by what's happening in our property markets. Now, not every show of the Michael Yardney podcast is going to be about coronavirus. I've got some great ones coming up, I know, because I've pre-recorded them. I've actually had to put them off a bit to put today's show on, but coming up will be Pete Borge and Tom Corley and all our regular segments. I look forward to catching up with you twice a week on the Michael Yardney podcast, but in between you can follow me on social media. Just look up Michael Yardney, and if you like the chats I have with Dr. Andrew Wilson, go to propertyinsiders.info, where you can subscribe to our YouTube channel, propertyinsiders.info, and of course my daily property update newsletter, where we keep you up to date with all the news. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?